Bank of Japan, European Central Bank, and the US Federal Reserve have all made their latest moves. Okay, the Bank of Japan did nothing, but the ECB raised by a higher than expected half percentage point, and the Fed raised by 3/4 of a percentage point. Now it's the Bank of England's turn, and the Monetary Policy Committee, or MPC, will announce its latest decision on interest rates and quantitative tightening on Thursday, the 4th of August. At its last meeting back in June, the MPC voted 6-3 for a 1/4 point increase in the base rate to 1.25%. That was the fifth straight increase, but note that the three dissenters voted for a half-point rise. Governor Andrew Bailey has now started to honour the possibility of a half-point increase this time around, especially as inflation is running at more than 4.5 times the bank's 2% target based on the Consumer Price Index. Ongoing weakness in sterling, which can increase import costs and thus further stoke inflation, will also be a consideration, although a sagging economy might be a greater concern still. Even so, inflation seems to be the old lady of Threadneedle Street's leading concern right now. As a result, markets are putting an 87% chance on a half-point increase to 1.75% at this meeting, with further increases in September, November, and December expected to take us to 2.75% by year end. However, markets are starting to price in a peak at around 3% and the possibility of a cut at some stage in late 2023. Now, this may be markets' way of saying, perhaps politely, that the bank was too late to start raising rates, and the increased risk of recession means it might now be too late to start cutting them again. It's never easy, is it? Now, in terms of quantitative easing or quantitative tightening, very quickly as it's now become, the debt buying programme peaked at £895 billion. By the 15th of June, the Bank of England's balance sheet had shrunk very slightly to £866 billion as it stopped reinvesting as bond holdings reach maturity, so keep an eye on that trend too. On the corporate front, we have a long list of announcements scheduled for the coming week, with around a sixth of the FTSE 100 due to release an update, full year or first half results. Names which may be worthy of further study because of what they say about themselves, their industry, or the economy more widely include the following, although some of these dates could still be subject to change. Long list, so get ready. Pearson, Spectris, Senior, Cranswick and Purple Bricks on Monday the 1st of August. BP, Sage, Fresnillo, Travis Perkins, Virgin Money UK, Rotork and Keller on the 2nd. Taylor Wimpey, Endeavour Mining, Wood Group, Hiscox and Hill and Smith on the 3rd. Glencore next, Rolls-Royce, Hikma, Mondi, Serco and Spirent on the 4th. And the London Stock Exchange, WPP, Pets at Home and Capita will round out the week on Friday the 5th of August. Even allowing for that lengthy roll call, the company which could just cause the biggest fuss in the week ahead is HSBC. Although it will be the last of the big five FTSE 100 banks to report when it does so on Monday the 1st of August, after Lloyds, Barclays, NatWest and Standard Chartered, the first half figures should be no less informative for that. At the time of recording, HSBC shares are up by around 30% over the past year, just behind Standard Chartered that's up by 1/3. The Asia-focused banks are therefore showing a clean pair of heels to the UK-focused ones. NatWest's up by around 15%, but Barclays and Lloyds are both down over the past 12 months, perhaps to reflect hopes that China will rebound quickly as lockdowns end and government stimulus measures kick in, while fears that the UK is heading into recession may be weighing on the other three, at least to varying degrees. Consensus earnings forecasts from analysts suggest that HSBC will make a headline pre-tax profit of around $14.7 billion for the whole of 2022, down from $18.9 billion in 2021, a year which benefited from provision and impairment reversals. Analysts do therefore, however, still expect to step up in 2023 and 2024, again perhaps to reflect the growth potential of the bank's core Asian markets. For this first half figure though, the consensus estimate is for stated pre-tax profit of $8.2 billion compared to $10.8 billion a year ago. Analysts and shareholders will then dig behind the headlines to look at the major swing factors. One will be loan and asset impairments. In the first half of last year, HSBC booked a profit here of $719 million as it wrote back some loan loss provisions from the COVID-stricken year of 2020. For the first half of this year, analysts have put in loan losses of $762 million, so that's a big swing. Another figure to watch will be net interest margin. This is expected to rise to 1.3% in Q2 from 1.26% in Q1 and 1.2% for the whole of 2020. Now, they might seem like small differences, but on a loan book of more than $1.1 trillion, every basis point counts. And one more figure to watch will be restructuring and any remediation or compensation costs. Q1 featured $457 million in costs here, nearly all restructuring, and the bill in the first half of a year ago was $955 million. Attention will then switch to the first half dividend, where analysts are looking for 8 US cents a share compared to 7 a year ago. For 2022 as a whole, consensus is looking for 28 cents a share compared to 25 last year. Note also HSBC completed a $2 billion share buyback program in April and launched another $1 billion buyback program almost immediately. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you next time.